Learn all about blockchain and crypto. Your one-stop guide to any or all things crypto. Whether you are a rookie trying to know stacking or a veteran looking to develop an investing strategies, we have you covered. Welcome to Crypto. We're on a mission to teach the masses on the transformative potential of cryptocurrency and blockchain technology. On our channel you will find videos covering everything from blockchain projects technology to economics. We know though it may be a touch daunting when you're new. Our aim is to carefully introduce you to a number of the key concepts you would like to kickstart your journey into the globe of blockchain tech. Subscribe to our channel and let's dive down the hole.
Hey there! We're diving headfirst into the wacky world of cryptocurrency. Now I know what you're thinking. Cryptocurrency sounds about as appealing as a root canal performed by a mime. But trust me on this one, it's way more interesting and less painful than it sounds. Imagine a world where you don't need banks to handle your money. That's the basic idea behind cryptocurrency. It's digital money that exists outside the control of governments and financial institutions. It's like the Wild West out there. But instead of tumbleweeds and saloons, we have digital tokens and online exchanges. Cryptocurrency uses cryptography, which is basically a fancy way of saying secret codes, to secure transactions and verify your identity. This ensures that your hard-earned digital cash doesn't magically disappear into the ether, which ironically is the name of a cryptocurrency. So, buckle up, Buttercup, because we're about to embark on a roller coaster ride through the ever-evolving landscape of cryptocurrency. Our story begins in 2009 with the birth of Bitcoin. No, it wasn't delivered by a stork or found under a cabbage patch. Bitcoin was brought into this world by a mysterious figure or figures known only as Satoshi Nakamoto. This shadowy figure, who is probably just a guy named Steve living in his mom's basement, created a decentralized digital currency that operates on a technology called blockchain. Think of blockchain as a giant public ledger that records every single Bitcoin transaction ever made. Now you might be wondering, why do we need a giant public ledger for internet money? Well, my friend, that's the beauty of Bitcoin. Since it's decentralized, there's no central authority like a bank to verify transactions. Instead, the blockchain does the heavy lifting, ensuring that every transaction is legitimate and secure. Bitcoin's arrival was like a bat signal to tech enthusiasts and financial rebels everywhere. It was the first successful attempt at creating a truly decentralized digital currency, and it sparked a revolution that continues to this day. As Bitcoin's popularity grew, so did the desire for more digital gold. Entrepreneurs, developers, and the occasional bored teenager with a laptop decided to create their own cryptocurrencies, known as altcoins. Ethereum, created in 2015, is like Bitcoin's cooler, more versatile cousin. It allows developers to build decentralized applications on its blockchain, opening up a world of possibilities beyond just digital currency. Then there's Ripple, a cryptocurrency designed for faster and cheaper cross-border payments. It's like Western Union, but without the exorbitant fees and questionable exchange rates. Litecoin, Dogecoin, Cardano, the list goes on and on. It's like a digital zoo out there, with each altcoin boasting its own unique features and quirks. Some of these altcoins have real potential, while others are about as useful as a screen door on a submarine. But hey, that's the risk you take in the Wild West of cryptocurrency. One of the most appealing aspects of cryptocurrency is its decentralized nature. In the traditional financial system, banks and governments hold all the power. They control the flow of money, set interest rates, and can even freeze your accounts if they feel like it. Cryptocurrency, on the other hand, is like the unruly teenager of the financial world. It doesn't answer to anyone. Transactions occur directly between users, without the need for intermediaries. It's like a giant peer-to-peer network where everyone has a say. This decentralization has profound implications. It means that cryptocurrency is resistant to censorship and government interference. Governments can't simply shut down a cryptocurrency network or seize your assets because they don't like what you're doing. This makes it an attractive option for people living in countries with unstable economies or repressive regimes. Miners, the unsung heroes of the blockchain. Remember that giant public ledger we talked about earlier, the blockchain? Well, someone has to maintain that ledger and make sure everything is running smoothly. That's where miners come in. No, we're not talking about dudes with pickaxes and hard hats. Cryptocurrency miners are basically the accountants of the digital world. They use powerful computers to solve complex mathematical problems, which verifies transactions and adds new blocks to the blockchain. It's a bit like a giant digital Sudoku puzzle, but instead of bragging rights, miners are rewarded with freshly minted cryptocurrency. Think of it as a digital gold rush, but instead of panning for gold, you're solving math problems. Mining is essential for maintaining the security and integrity of the blockchain. It ensures that no single entity can control the network or manipulate transactions. So, the next time you make a cryptocurrency transaction, take a moment to thank the miners. They're the unsung heroes keeping the system afloat. Global currency, breaking down financial barriers. Cryptocurrency doesn't care about borders, passports, or exchange rates. It's the ultimate global currency. You can send and receive cryptocurrency anywhere in the world with an internet connection, making it ideal for international transactions. This is a game changer for people in developing countries who often rely on expensive and unreliable remittance services. Cryptocurrency allows them to send and receive money quickly and cheaply, bypassing traditional financial institutions. It also levels the playing field for businesses by reducing transaction fees and eliminating the need for currency conversions. Imagine a world where a small business in rural India can seamlessly transact with a customer in New York City without losing a huge chunk of their profits to fees. That's the power of cryptocurrency. One of the most debated aspects of cryptocurrency is its balance between privacy and transparency. On the one hand, all transactions are recorded on the public blockchain, which is about as private as a billboard in Times Square. However, the identities of the parties involved in those transactions are usually hidden behind anonymous addresses. It's like a masked ball for your finances. You can see the transactions taking place, but you don't know who's behind the mask. This anonymity has raised concerns about illicit activities such as money laundering and tax evasion. After all, if no one knows who you are, it's easier to get away with shady dealings. On the other hand, this anonymity also provides a level of financial freedom that's unheard of in traditional systems. It allows people to transact without fear of censorship or discrimination. The debate over privacy and transparency is likely to continue as cryptocurrency becomes more mainstream. The challenge is to find a balance that allows for both financial freedom and accountability. While Bitcoin gets all the headlines, the real revolution is happening behind the scenes with blockchain technology. Remember that giant public ledger we discussed earlier? It turns out that it has a lot more uses than just tracking digital currency. Take supply chain management, for instance. Blockchain can be used to track products from the factory floor to the store shelf, ensuring authenticity and reducing fraud. It's like having a digital trail of breadcrumbs that reveals every step of a product's journey. In healthcare, blockchain can be used to securely store and share patient data, improving efficiency and reducing errors. It's like having a medical record that follows you wherever you go, without the risk of it getting lost or stolen. Blockchain can even be used to create more secure and transparent voting systems. No more hanging chads or accusations of rigged elections. Blockchain ensures that every vote is counted accurately and securely. These are just a few examples of the many ways blockchain is being used to revolutionize industries. As the technology continues to evolve, we can expect to see even more innovative applications emerge. So, what does the future hold for cryptocurrency? Well, if I had a crystal ball that could predict the future of finance, I wouldn't be wasting my time hosting a satirical news show. I'd be sipping margaritas on a private island, counting my stacks of Bitcoin. But even without a crystal ball, it's clear that cryptocurrency is here to stay. It's already disrupting traditional financial systems and empowering individuals in ways we never thought possible. Will Bitcoin become the global reserve currency, replacing the US dollar? Will we all be paying for our morning coffee with Dogecoin? Will I finally understand how to explain cryptocurrency without resorting to ridiculous analogies? Only time will tell. But one thing's for sure, the future of finance is going to be digital, decentralized, and a little bit weird. And honestly, I wouldn't have it any other way. Remember, never trust a mime, especially if they're offering you financial advice. The world of money is changing. We are moving from physical cash to digital currencies. This new form of money is called cryptocurrency. Cryptocurrency is a digital form of money. It uses cryptography for security. Cryptocurrency is decentralized. Transactions happen directly between users. This is made possible by blockchain technology. A blockchain is a digital ledger. Cryptocurrency offers a new way to think about money. Imagine a world without banks. You could send money to anyone, anywhere instantly. This is the promise of cryptocurrency. It offers a glimpse into a future of decentralized finance. Join us as we navigate the exciting and rapidly evolving world of cryptocurrency. Cryptocurrency operates on a revolutionary concept, peer-to-peer networks. Unlike traditional financial systems that rely on intermediaries like banks, cryptocurrency transactions occur directly between users. In a P2P network, each user acts as a node, contributing to the network's functionality. This decentralized structure eliminates the need for a central authority. Transactions are broadcast to the network and verified by multiple participants. P2P networks are the backbone of cryptocurrency, enabling fast, secure, and low-cost transactions. Decentralization is at the very core of cryptocurrency. It signifies the absence of a central authority controlling the currency. Unlike traditional currencies issued and regulated by governments, cryptocurrency operates on a distributed network. This means no single entity has absolute control, promoting transparency and fairness. Decentralization safeguards cryptocurrency from government interference or manipulation. Cryptocurrency offers a new level of security and transparency in financial transactions. Blockchain technology ensures that all transactions are recorded on a public and immutable ledger. This means every transaction is verifiable and traceable, reducing the risk of fraud. Complex mathematical algorithms secure transactions, making it virtually impossible to counterfeit or double-spend coins. The transparency of the blockchain also allows for greater accountability. This increased security and transparency are key factors driving the growing adoption of cryptocurrency worldwide. The story of cryptocurrency begins in 2008. The global financial system was in crisis, trust in traditional institutions was shaken. From this turmoil, a revolutionary idea emerged. An anonymous entity under the pseudonym Satoshi Nakamoto introduced Bitcoin to the world. Bitcoin was more than just a digital currency. It proposed a system where money could exist and be transferred without the need for banks or governments. Nakamoto released the Bitcoin white paper in October 2008. On January 3, 2009, the Bitcoin network came into existence. This marked the beginning of a new era in finance. At the heart of Bitcoin and all cryptocurrencies lies the revolutionary technology of blockchain. Imagine a digital ledger, distributed across a network of computers, recording every transaction in a secure and transparent manner. Each block in the chain contains a record of multiple transactions. Once a block is added to the chain, it cannot be altered or removed. The decentralized nature of blockchain further enhances security. Blockchain technology is not limited to cryptocurrency. Its potential applications are vast and varied. Bitcoin's emergence paved the way for a wave of new cryptocurrencies, collectively known as altcoins. These alternative coins sought to improve upon Bitcoin's design or explore new use cases for blockchain technology. One of the earliest and most successful altcoins is Litecoin. Created in 2011, Litecoin aimed to be the silver to Bitcoin's gold. As the cryptocurrency market matured, altcoins diversified to address specific needs and challenges. The rise of altcoins highlights the innovative spirit and rapid evolution of the cryptocurrency space. While Bitcoin pioneered the concept of decentralized digital currency, Ethereum took blockchain technology a step further. Created by Vitalik Buterin in 2015, Ethereum introduced the concept of smart contracts. These contracts are essentially lines of code that automatically execute when predetermined conditions are met. Ethereum became a platform for building decentralized applications, or dApps. From decentralized finance to supply chain management, Ethereum's dApps are transforming industries. Ethereum's impact on the cryptocurrency world has been profound, fostering innovation and expanding the possibilities of blockchain technology. Ripple distinguishes itself with a specific focus, revolutionizing global financial transactions. Ripple targets financial institutions and aims to streamline their cross-border payment systems. At the heart of Ripple's offering is the XRP Ledger, enabling faster and cheaper international money transfers. Banks find Ripple's solution particularly appealing. Ripple's impact on cross-border payments is undeniable, pushing the boundaries of how financial institutions can leverage blockchain technology. The world of cryptocurrency extends far beyond Bitcoin and Ethereum. Litecoin and Cardano have carved their own niches, contributing to the diversity and evolution of the digital asset landscape. Litecoin prioritizes faster transaction speeds and lower fees. Cardano emphasizes scalability, security, and sustainability. Both Litecoin and Cardano embody the constant innovation within the cryptocurrency space. These altcoins contribute to a vibrant ecosystem, offering users and developers a diverse range of options to explore and utilize. One of the most defining characteristics of cryptocurrency is its decentralized nature. Unlike traditional currencies controlled by central banks, cryptocurrency operates on a distributed network. This means no single entity has absolute control over the network. This lack of central authority empowers individuals by giving them direct control over their assets. This distributed nature also makes cryptocurrency resistant to censorship. Decentralization fosters trust by allowing anyone to verify transactions on the public blockchain. It represents a shift in power from centralized institutions to individuals, promoting financial freedom and empowering users globally. Cryptocurrency empowers individuals by granting them unprecedented autonomy over their finances. In traditional systems, individuals often rely on banks or financial institutions to facilitate transactions. Cryptocurrency changes this dynamic by enabling peer-to-peer transactions without the need for intermediaries. Users have direct control over their funds and can send and receive payments directly. This level of financial autonomy is particularly empowering for individuals in countries with unstable currencies. Cryptocurrency's emphasis on user autonomy is a key factor driving its adoption among individuals seeking greater control over their finances. Cryptocurrency transcends geographical boundaries, facilitating seamless global transactions. Unlike traditional cross-border payments, cryptocurrency transactions occur on a global, decentralized network. This enables users to send and receive payments worldwide without the need for traditional intermediaries. The speed and affordability of cryptocurrency transactions make it an attractive alternative for remittances and international trade. Cryptocurrency has the potential to promote financial inclusion by providing access to financial services for underserved populations. Individuals only need a smartphone and an internet connection to create a cryptocurrency wallet. Cryptocurrency's ability to transcend geographic boundaries and promote financial inclusion has significant implications for global economic development. Blockchain's potential extends far beyond digital currencies. It's a secure, transparent system for recording and verifying information. This capability sparks innovation across sectors, revolutionizing processes. In supply chain management, blockchain tracks products from origin to consumer. This enhances traceability, reduces fraud, and improves efficiency. In healthcare, it securely stores and shares patient records. Blockchain's transformative capabilities continue to expand across industries. Blockchain is a trust machine. Its decentralized nature fosters trust and accountability. Traditional models rely on intermediaries like banks and governments. This creates vulnerabilities such as fraud or data breaches. Blockchain enables direct peer-to-peer interactions. Transactions are recorded on a public, immutable ledger. This transparency ensures accountability. Immutability guarantees data cannot be altered. This creates a tamper-proof record. Blockchain's trust and accountability impact various sectors. In supply chains, it verifies product authenticity. In voting, it ensures election integrity. In finance, it reduces fraud risk. Blockchain's evolution will drive adoption and unlock new possibilities. The world of cryptocurrency is brimming with potential, but faces significant challenges. One major issue is its notorious price volatility. Unlike traditional currencies, cryptocurrencies like Bitcoin experience dramatic price swings. This volatility poses risks for users and businesses. Accepting cryptocurrency as payment can be risky. Market speculation, regulatory news, and social media sentiment drive this volatility. Adding to the uncertainty is the evolving regulatory landscape. Governments worldwide grapple with how to regulate cryptocurrencies. This lack of clarity creates uncertainty for businesses and investors. Despite growing interest, cryptocurrency adoption faces significant hurdles. Technical complexity and security concerns are major barriers. Understanding blockchain, private keys, and wallets can be daunting. High-profile hacks and phishing scams erode trust. Improving security and user experience is crucial for adoption. Cryptocurrency's environmental impact, especially Bitcoin, is under scrutiny. Bitcoin's proof-of-work mechanism requires energy-intensive mining. Miners solve complex problems to add blocks and earn rewards. This process consumes significant energy. Critics argue it contributes to carbon emissions. The debate is complex. Proponents say it drives renewable energy development. Environmental concerns remain contentious. Ethical issues also arise. Anonymity can lead to misuse for illicit activities. Regulations are needed to mitigate risks. Addressing these issues is crucial for sustainability. As we stand at the cusp of a new financial era, cryptocurrency has emerged as a powerful force, challenging traditional notions of money, finance, and the global economy. Its decentralized nature, powered by the revolutionary technology of blockchain, has ignited a wave of innovation, empowering individuals and disrupting established industries. The journey of cryptocurrency, from its humble beginnings as a fringe experiment to its current status as a multi-trillion-dollar asset class, has been nothing short of remarkable. Yet the path forward is not without its challenges and uncertainties. Price volatility, regulatory hurdles, security concerns, and environmental impact are among the critical issues that need to be addressed for cryptocurrency to reach its full potential. Navigating this evolving landscape requires a balanced approach, one that fosters innovation while mitigating risks and ensuring responsible development. Governments, regulators, businesses, and individuals all have a role to play in shaping the future of cryptocurrency. The coming years will be crucial in determining whether cryptocurrency can fulfill its promise of a more open, inclusive, and equitable financial system. The future of cryptocurrency hinges on responsible innovation, balancing technology with ethics, sustainability, and societal needs. Collaboration among stakeholders is essential. Governments must establish clear regulations to protect consumers and prevent illicit activities. Balancing regulation and innovation is crucial. Businesses must prioritize security, transparency, and user-friendliness. Addressing security and improving user experience builds trust. Individuals must educate themselves and adopt safe practices. By working together, we can harness cryptocurrency's power responsibly. The journey of cryptocurrency is just beginning. As technology continues to evolve and mature, we can expect even more innovative applications and use cases to emerge, further blurring the lines between the physical and digital worlds. Blockchain technology, the foundation of cryptocurrency, has the potential to revolutionize industries beyond finance, transforming supply chains, healthcare, governance, and countless other sectors. The transformative potential of cryptocurrency is undeniable. It has the power to empower individuals, foster financial inclusion, and create a more equitable and accessible global economy. However, realizing this potential requires us to navigate the challenges responsibly, prioritizing security, sustainability, and ethical considerations. The future of cryptocurrency is not predetermined. It is a future we are actively shaping through our choices, actions, and collective efforts. It is a future where technology and innovation can empower individuals, break down barriers, and create a more just and equitable world. As we embark on this transformative journey, let us proceed with both excitement and caution, embracing the opportunities while mitigating the risks, and working together to shape a future where cryptocurrency benefits all of humanity. It's a revolution in how we think about money, but it's as regulated as drunk Jenga on a roller coaster. Isn't money already digital? I haven't seen a physical dollar since the farmer's market, but cryptocurrency is different. It's like owning a movie versus streaming it. One's tangible, the other's a hope. Buckle up for the world of cryptocurrency where fortunes are made and lost fast. If you're confused, don't worry, we'll get there. Now let's talk about the elephant in the room, or rather, the lack of elephants in the room. Because when it comes to traditional finance, those without access might as well be dealing with mythical creatures. Getting a bank account often requires a physical address, valid identification, and a credit history. For many, these are luxuries, not givens. It's like asking someone to prove they exist in a system that's designed to ignore them. Cryptocurrency, on the other hand, doesn't discriminate. It doesn't care about your credit score, your address, or even your name if you're feeling particularly anonymous. All you need is a digital wallet, which is kind of like a digital piggy bank but with fewer fire hazards. This ease of access is a game changer, particularly for those in developing countries where traditional banking infrastructure is limited. It empowers individuals, fosters entrepreneurship, and allows economies to flourish outside the confines of the established financial system. So, imagine a world where sending money across borders is as easy and affordable as sending an email. No more exorbitant fees, lengthy processing times, or dealing with the existential dread of Western Union. That's the promise of cryptocurrency for remittances, the lifeblood of many developing economies. Migrant workers can send money back home to their families without losing a significant chunk of their hard-earned wages to intermediaries. Small businesses can access international markets, expanding their reach and boosting their bottom line, and families can support each other across continents without jumping through hoops or selling off vital organs. It's about leveling the playing field, giving everyone a chance to participate in the global economy. And that, my friends, is a beautiful thing. Even if it still involves trying to explain to your grandmother what Bitcoin actually is. Alright, let's talk speed. Specifically, the speed of transactions. Now, if you've ever sent money internationally using traditional banks, you know it's like watching paint dry. It's slow, it's expensive, and frankly, it feels like you're sending a telegram with a carrier pigeon. Cryptocurrency, on the other hand, is like strapping your money to a cheetah with a rocket pack. Transactions, even across borders, happen in minutes, sometimes even seconds. No more waiting days for bank transfers to clear, and the best part, the fees are significantly lower. You see, traditional finance relies on these intermediaries, like banks, to process everything. It's like having to go through 17 different security checkpoints at the airport just to buy a magazine. Cryptocurrency cuts out these middlemen, making the whole process faster and cheaper. Now you might be thinking, I'm not shipping diamonds across continents every day, why do I care about transaction speed? Well, my friend, in our increasingly globalized world, speed matters. Businesses, especially small businesses, rely on quick and efficient payments to keep things running smoothly. Delays in payments can disrupt their cash flow, impact their ability to pay employees and suppliers, and ultimately hinder their growth. Cryptocurrency levels the playing field, allowing small businesses to compete on a global scale without being bogged down by slow and expensive transactions. It's like finally giving them access to the same financial tools as the big corporations, without all the red tape. So, the next time you're impatiently waiting for a bank transfer to go through, remember the cheetah. Remember the rocket pack. And remember, there's a faster, more efficient way to move money in the digital age. Let's talk about trust, shall we? Specifically, the lack of it in traditional financial systems. Now we're told to trust banks, these big, faceless institutions with our hard-earned money. But history, my friends, is littered with examples of banks behaving badly. Cryptocurrency, with its blockchain technology, flips the script. Imagine a giant public ledger that records every single transaction made with a particular cryptocurrency. That's blockchain in a nutshell. And this ledger isn't hidden away in some bank vault. Think about it. Supply chains, notoriously opaque and prone to fraud, can become radically transparent with blockchain. Imagine tracking your food from farm to table, knowing exactly where it came from and who handled it along the way. Or consider voting systems, often plagued by allegations of rigging and manipulation. Blockchain-based voting could provide a secure and verifiable way to ensure that every vote is counted accurately. And let's not forget about charities and NGOs. With blockchain, donors can track exactly how their contributions are being used, ensuring that their money is actually making a difference. Transparency is the foundation of trust. Alright, let's address the elephant in the room: security. Now, whenever cryptocurrency comes up, some people turn into nervous hamsters, convinced that their digital fortune is one click away from vanishing into the ether. But here's the thing. Cryptocurrency, when properly secured, is actually incredibly difficult to steal. Think Fort Knox levels of security, but instead of armed guards and laser beams, it's cryptography and decentralization. Cryptocurrency transactions are secured using complex mathematical algorithms, making them virtually impossible to tamper with. And because the network is decentralized, there's no single point of failure that hackers can target. It's like trying to rob a bank that exists simultaneously in every city in the world. Good luck with that. But security is only half the equation. Privacy matters too. In an age where our every online move is tracked, analyzed, and monetized, cryptocurrency offers a refreshing degree of anonymity. Now, I'm not talking about the kind of anonymity that lets you get away with shady business dealings. We're talking about taking back control of your personal data and financial information. Cryptocurrency transactions can be pseudonymous, meaning they're not directly linked to your real-world identity. This allows for greater privacy in your financial dealings, shielding you from prying eyes and data-hungry corporations. So, while cryptocurrency might seem complex and intimidating at first, remember this. It's designed to protect your money and your privacy in an increasingly digital world. Alright, let's talk about the sexy part of cryptocurrency, and no, I don't mean the part where your uncle tries to explain Bitcoin at Thanksgiving. I'm talking about its potential to revolutionize how we interact in the digital world. See, most cryptocurrencies are built on open-source blockchain platforms like Ethereum. Think of it as the Wild West of coding, where anyone with a laptop and a dream can build the digital equivalent of a saloon, or a brothel, or hopefully something a bit more useful. How does blockchain translate into real-world applications? Let's start with food. Track your organic kale from farm to plate. That's blockchain and supply chain management. But it doesn't stop there. Revolutionizing healthcare by securely storing medical records, giving you control of your data. Transforming gaming with true ownership of digital assets. Creating secure and transparent voting systems. No more long lines for voting. The possibilities are endless. Until the next global pandemic. Now let's talk about something near and dear to all our hearts: money. Specifically, how to make more of it. And no, I'm not talking about that pyramid scheme your coworker keeps trying to rope you into. I'm talking about cryptocurrency as an investment. Now, before you remortgage your house and invest it all in Dogecoin because Elon Musk tweeted a picture of a Shiba Inu wearing a spacesuit, let's be clear. Cryptocurrency is volatile. Like really volatile. It's the financial equivalent of a sugar-fueled toddler on a trampoline. But for those who can stomach the ups and downs, it can be a way to diversify your portfolio and potentially hedge against inflation. Think of it this way, you wouldn't put all your eggs in one basket unless you're particularly clumsy, in which case maybe you should just stick to index funds. Now, I'm not a financial advisor, and frankly, I'm not even sure how I ended up with a job that requires me to wear pants. But even I can see the appeal of an asset class that isn't controlled by any government or financial institution. It's like the financial equivalent of that off-the-grid cabin in the woods you fantasize about escaping to when your boss is being particularly unbearable. Let's talk about the strivers, the dreamers, the people creating amazing content online. The traditional internet economy hasn't been kind to these folks. But cryptocurrency offers hope with micropayments. Imagine tipping your favorite artist a few cents for a song. That's the promise of cryptocurrency. And it's not just about supporting individual creators. Cryptocurrency is also enabling entirely new business models. We're talking about decentralized marketplaces where artists can sell directly to fans, cutting out the middleman and keeping more of the profits. We're talking about new ways to monetize digital goods and services in the gig economy, from freelance work to online gaming. Alright, so we've spent the last little while waxing poetic about the glorious decentralized future cryptocurrency promises. And sure, it has the potential to revolutionize hamster-based payment systems and let us all finally buy that solid gold statue of a meerkat wearing a monocle. But, and this is a big but like a Kardashian at a buffet, there are some downsides. Remember all that talk about financial inclusion and disrupting the old, dusty banking system? Well, turns out crypto can be just as volatile as my emotional state after a week-long bender on sugar-free gummy bears. We're talking wild swings in value, the kind that would make a roller coaster enthusiast vomit with envy. Let's start with the elephant in the room, or should I say, the wildly fluctuating price ticker on the wall of your cryptocurrency exchange, volatility. Cryptocurrencies are about as stable as a newborn giraffe on roller skates. One minute they're soaring, the next they're plummeting. Some thrill seekers might find this exciting, but for the average person, this level of volatility is concerning. It makes it difficult to use cryptocurrency for everyday transactions. Imagine trying to buy a cup of coffee with Bitcoin when the price fluctuates by 10%. You might walk in with enough to buy the entire coffee shop and walk out with a single sip. And that, my friends, is the problem with volatility in a nutshell. We've talked about the Wild West of cryptocurrency prices, but hold on to your digitally mined gold, because it gets even wilder. Remember all that talk about security and anonymity? Turns out that very same anonymity that makes cryptocurrency so appealing to libertarian hamsters and people who forget to pay their taxes, also makes it incredibly attractive to a less savory crowd, criminals. We're talking hackers, scammers, and the kind of people who think it's a good idea to invest their life savings in a cryptocurrency called Doge Moon Elon Mars 69. And they're not just after your grandma's computer anymore. Oh no, they're setting their sights on something much bigger: cryptocurrency exchanges. Cryptocurrency is the future. It's decentralized, it's secure. Bless your naive little heart. Blockchain is secure, but humans aren't. Criminals are lazy. They use stolen identities. That's where KYC comes in. KYC regulations verify identities. Sounds great in theory, but it's chaotic, like herding cats on a unicycle. It's messy and rarely works. Criminals exploit loopholes and use cryptocurrency for crimes. So far, we've established that cryptocurrency is volatile, vulnerable to hackers, and a favorite tool of criminals. But wait, there's more. Just when you thought the digital Wild West couldn't get any wilder, in stroll the sheriff's governments and their trusty sidekick, regulation. Now, governments, much like a confused grandpa trying to figure out how to use a smartphone, have been slow to understand cryptocurrency. For years, they've largely ignored it, treating it like that weird, smelly kid in the back of the class who insists on paying for their Lunchables with bottle caps. But as cryptocurrency has grown in popularity, and more importantly, in value, governments have started to take notice. So, what's a government to do? They could ban cryptocurrency outright, or try to regulate it, or embrace it with central bank digital currencies. The results are likely to be mixed. The regulatory landscape is confusing and varies by country. One day you're a law-abiding citizen, the next you're a financial criminal. Alright, let's address the Bitcoin in the dark web. Cryptocurrency's anonymity attracts unsavory characters. Remember Silk Road? Not the ancient trade route. It was an online black market for illicit goods. And the currency of choice? Bitcoin. Any tool can be used for good or evil. Governments and financial institutions aren't just sitting around. They're actively working to combat the use of cryptocurrency for illegal activities. Think of it like a city built of winding alleyways. That's the early internet in cryptocurrency. You install streetlights and traffic cameras. That's cryptocurrency regulation now. Stricter, know your customer, KYC rules require exchanges to verify identities. As regulations evolve, the alleyways get less shadowy. Remember the early days of the internet, the Wild West where anything went? Early cryptocurrency days were like that. But with blockchain talk instead of cowboy hats, governments were initially caught off guard by cryptocurrency. It was like a new species of financial animal in their garden. Governments aren't known for speed. Regulating cryptocurrency is like herding cats. Only the cats are in suits arguing about tax codes. The result? A patchwork of regulations. Some embrace it, others shut the door. So, what does this regulatory uncertainty mean for the future of cryptocurrency? Well, it's complicated. Clear regulations are crucial for adoption. Businesses need to know the rules to plan confidently. Imagine playing a game where the rules change every 5 minutes. That's what it's like for cryptocurrency businesses now. Too much regulation could stifle innovation. The good news is that the conversation is happening. It's a messy process, but so is democracy. Alright, let's talk about the environmental impact of cryptocurrency because it's not all sunshine, rainbows, and magic internet money. One of the biggest concerns is the energy consumption of cryptocurrency mining, especially for currencies like Bitcoin that use a system called proof of work. Now, I know what you're thinking. Proof of work? Sounds like something my kid made up to get out of chores. But unfortunately, it's very real, and it's very energy intensive. Basically, it involves computers around the world competing to solve complex mathematical problems to validate transactions and add them to the blockchain. Now, before you go full-on Greta Thunberg and chain yourself to a Bitcoin ATM, it's worth noting that the cryptocurrency world is aware of this issue and is actively exploring solutions. Some cryptocurrencies are switching to more energy-efficient consensus mechanisms like proof of stake, which doesn't require all that computational heavy lifting. Think of proof of stake like a raffle where the more cryptocurrency you hold, the more tickets you get. It's still a competition, but instead of wasting energy on pointless calculations, it's based on who has the most skin in the game. This significantly reduces the environmental impact, making it a much greener alternative. So, we've talked about the environmental impact of cryptocurrency, but let's face it, even if we solve that problem, there's another hurdle to overcome: scalability. You see, as more people and businesses adopt cryptocurrency, the underlying blockchain technology can get a bit, shall we say, constipated. Remember how we talked about blockchain being like a giant public ledger? Well, imagine that ledger being written in by hand, one transaction at a time. Now imagine millions of people trying to write in that ledger simultaneously. It would be absolute chaos, right? And that's kind of what happens when a blockchain network gets overloaded. Before you swear off cryptocurrency forever, developers are aware of scalability issues and are working tirelessly to find solutions. One approach is improving existing blockchain networks, like optimizing your internet router. Another is developing new blockchain architectures for scalability. Layer 2 solutions. Process transactions off the main blockchain, like express lanes on a highway, allowing faster, cheaper transactions. Imagine buying coffee without waiting for global verification. That's the goal of Layer 2 solutions. These solutions are still in development, and it remains to be seen which will prevail. So there you have it. We've explored the exhilarating highs and the potentially devastating lows of the cryptocurrency world, from its promise of financial inclusion and decentralized systems to the environmental concerns and scalability challenges. It's clear that this technology is a complex and rapidly evolving beast. But one thing's for sure, cryptocurrency is here to stay. It's already disrupting traditional finance and forcing us to rethink how we think about money, value, and the very nature of transactions. Whether it ultimately fulfills its utopian potential or succumbs to its inherent flaws remains to be seen. But as with any powerful technology, the responsibility lies with us, the users, to ensure that it's used for good. We need to demand transparency, accountability, and sustainability from the industry, and we need to educate ourselves about the risks and rewards before diving headfirst into the digital gold rush. We're diving headfirst into the world of cryptocurrency rewards. Specifically, we're talking about how to make money with crypto arbitrage. Now, you've probably heard the stories, the mind-blowing returns, people turning a few $1,000s into millions practically overnight. And while it's true that crypto has the potential for some crazy gains, It's important to remember that this market is like a bucking bronco. It can be incredibly volatile. It's not about getting rich quick, it's about understanding the game, managing your risk, and making smart decisions. We're going to break down different strategies, from long-term investing to more active trading, and even some lesser-known methods. We'll cover the pros and cons of each, so you can figure out which approach aligns best with your risk tolerance and financial goals. Remember, knowledge is power, especially in the crypto space. So buckle up, hit that subscribe button, and let's get started. One of the most popular strategies, especially for beginners, is the buy and hold approach, or, as it's affectionately known in the crypto world, hodling. Essentially, you're betting on the long-term growth of a particular cryptocurrency, believing that its value will increase significantly over time. Think of it like investing in real estate. You buy a property, you hold on to it for years, maybe even decades, and ideally, its value appreciates. Similarly, with crypto, you're buying a digital asset with the expectation that its value will go up in the future. Now, this strategy requires patience. You're not going to get rich overnight. There will be ups and downs, periods of volatility where the market dips and you might feel tempted to sell. But the key is to weather the storm, to trust in your research and your long-term vision. Remember, Rome wasn't built in a day, and neither are massive crypto portfolios. If you believe in the underlying technology and the potential of a particular cryptocurrency, holding on to it for the long haul can be a very rewarding strategy. Now, if you're looking for a more active approach to crypto investing, trading might be more your speed. Unlike long-term investing, trading involves buying and selling cryptocurrencies over shorter time frames, aiming to profit from the market's volatility. Think of it like surfing. You're trying to catch the waves, riding them up and down to make a profit. But just like surfing, crypto trading requires skill, timing, and a good understanding of the market. There are different styles of trading, from day trading, where you open and close positions within the same day, to swing trading, which involves holding trades for a few days or even weeks. Each style comes with its own set of risks and rewards. The key to successful trading is to develop a strategy and stick to it. This involves identifying entry and exit points, setting stop-loss orders to limit potential losses, and managing your risk effectively. Now let's dive into a fascinating strategy called crypto arbitrage. You see, unlike the stock market, which is heavily regulated and centralized, the crypto world is like the Wild West. With thousands of exchanges operating independently, price discrepancies for the same cryptocurrency can emerge across different platforms. Imagine finding Bitcoin listed at $29,500 on one exchange and $29,800 on another at the exact same time. That, my friends, is an arbitrage opportunity. You buy low on the first exchange and sell high on the second, pocketing the $300 difference minus any trading fees. Sounds simple, right? Well, it's a bit more complicated than that. Speed is key in arbitrage. These price differences often disappear within seconds as other arbitrageurs jump on them. You need to be faster than a cheetah on espresso to capitalize on these opportunities. That's why many arbitrage traders use sophisticated bots, automated programs that constantly scan multiple exchanges for price discrepancies and execute trades at lightning speed. It's like having a team of expert traders working for you 24/7. Ever wondered how new Bitcoin comes into existence? Well, it's not through some magical money printer. It's through a process called mining, which is the backbone of the entire blockchain technology. Think of mining like solving complex mathematical equations. Miners use powerful computers to solve these equations, and the first one to solve it gets to add a new block of transactions to the blockchain. This process is what verifies and secures the entire network. As a reward for their computational work, miners receive newly minted cryptocurrency and transaction fees. It's like getting paid to keep the system running. Back in the early days of Bitcoin, you could mine with a simple laptop. But as the network grew and more miners joined the game, the difficulty increased exponentially. Today, you need specialized hardware called ASIC miners, which are specifically designed to mine cryptocurrency. These ASICs are expensive, consume a ton of electricity, and generate a lot of heat. Now, let's talk about a more energy-efficient and accessible alternative to mining: staking. Unlike mining, which relies on computational power, staking involves holding and locking up your cryptocurrency to support the network's security and operations. Think of it like depositing money in a bank account and earning interest. When you stake your crypto, you're essentially pledging your coins to the network, and in return, you get rewarded with a percentage yield. It's like earning passive income while you sleep. Staking is particularly popular with proof-of-stake coins, which are designed to be more energy efficient and scalable than traditional proof-of-work coins like Bitcoin. Some popular POS coins include Ethereum, Cardano, and Solana, just to name a few. Now, the beauty of staking is that it's much easier to get started than mining. You don't need expensive hardware or technical expertise. All you need is a compatible wallet and some cryptocurrency to stake. Now, maybe you like the idea of Bitcoin, but actually buying and holding the cryptocurrency itself just seems a little bit too volatile for you. The wild price swings can be nerve-wracking, and the thought of losing a significant portion of your investment overnight might be too much to handle, and hey, I get it. The crypto market is definitely not for the faint of heart. The volatility can be extreme, and it requires a strong stomach to ride out the ups and downs. But that doesn't mean you have to miss out on the potential gains entirely. There are other ways to get involved in the crypto space without having to deal with the direct ownership of Bitcoin. There are actually ways to get exposure to the crypto market without going all in on Bitcoin itself. You can still benefit from the growth of the cryptocurrency market through other investment vehicles. One of the best ways to dip your toes into the crypto waters is by looking at Bitcoin-related stocks and ETFs. These investment options allow you to gain exposure to the crypto market without the need to directly buy and hold Bitcoin. These are publicly traded companies that are heavily involved in the cryptocurrency ecosystem. They might be engaged in various activities such as mining Bitcoin, running cryptocurrency exchanges, or developing blockchain technology. Think companies that are mining Bitcoin, running cryptocurrency exchanges, or developing blockchain technology. These companies are at the forefront of the crypto revolution and stand to benefit from its growth. Now, the beauty of investing in these stocks and ETFs is that you get the benefit of diversification. By investing in a range of companies, you can spread your risk and potentially increase your chances of seeing positive returns. You're not putting all your eggs in one basket by investing in a single cryptocurrency. Instead, you're diversifying your investment across multiple companies that are all involved in the crypto space. Instead, you're spreading your risk across a range of companies that are all benefiting from the growth of the crypto market. This can help mitigate some of the risks associated with investing in a single asset. Plus, because these are publicly traded companies, you get all the same investor protections and regulations that come with traditional stock investing. This can provide an extra layer of security and peace of mind. Especially if you're new to the world of crypto. By investing in Bitcoin-related stocks and ETFs, you can participate in the growth of the cryptocurrency market while enjoying the benefits of traditional stock investments. Now, let's talk about a high-risk, high-reward avenue in the crypto space: initial coin offerings, or ICOs. These are essentially a way for new cryptocurrency projects to raise funds by selling a portion of their tokens to early backers. It's a bit like crowdfunding, but with a twist. Imagine getting in on Amazon or Apple stock before they went public. That's the kind of potential ICOs hold. The idea is to provide early investors with a chance to buy into a project at a lower price, with the hope that the value of the tokens will increase as the project gains traction and popularity. They allow you to purchase brand new cryptocurrencies or tokens at their earliest stages, often before they even hit major exchanges. This early access can be incredibly lucrative if the project succeeds, as the tokens you bought for pennies could be worth dollars or even more in the future. The appeal is obvious. You're getting in on the ground floor. Just like investing in a startup, you're supporting a project from its infancy, which can be both exciting and financially rewarding. If the project takes off, your early investment could skyrocket in value. We've seen tokens increase in value by hundreds or even thousands of %, turning small investments into substantial gains. We've seen some incredible success stories in the ICO world, with early backers reaping massive returns. Projects like Ethereum and NEO started as ICOs and have since become major players in the crypto space. But, and this is a big but, there's also a lot of risk involved. The high potential rewards come with equally high risks, and it's crucial to be aware of them. ICOs are largely unregulated, which means there's potential for scams and fraudulent projects. Some projects may promise the moon, but deliver nothing, leaving investors with worthless tokens. That's why due diligence is absolutely critical. You need to scrutinize every aspect of the project before investing your hard-earned money. You need to thoroughly research the team behind the project, their white paper, the technology, and the overall market demand for their idea. Look into their past projects, their expertise, and their vision for the future. Don't just jump in blindly because everyone else is. Do your homework, read reviews, join community discussions, and get a sense of the project's credibility and potential. Remember, not every ICO is going to be the next Bitcoin. Many projects will fail to deliver on their promises, and some may even disappear entirely. In fact, a lot of them will likely fail. It's a harsh reality, but one that every potential investor needs to understand. But if you're smart, strategic, and you do your research, ICOs can be a way to potentially multiply your money in a big way. The key is to be informed and cautious. Just go in with your eyes wide open, understand the risks, and never invest more than you can afford to lose. With the right approach, ICOs can be a thrilling and profitable venture. We've covered a lot of ground in this video, from long-term holding to high-frequency trading. Each strategy has its own set of risks and rewards, and understanding these is crucial for any investor, from mining to staking. But no matter what approach you choose, there's one thing that remains constant: the importance of risk management. The crypto market is incredibly volatile. Prices can swing dramatically in short periods, and what goes up can just as easily come down. That's why it's crucial to never invest more than you can afford to lose. This is money you should be comfortable kissing goodbye if the market takes a turn for the worse. Always have a safety net and never put your financial stability on the line for potential gains. Don't let emotions dictate your investment decisions. It's easy to get caught up in the hype and FOMO, fear of missing out, when you see prices soaring, but that's often when people make the biggest mistakes. Stick to your strategy, manage your risk, and don't chase pumps. Emotional trading can lead to significant losses, and it's essential to remain calm and collected, even when the market is turbulent. Remember, investing in crypto is a marathon, not a sprint. Slow and steady wins the race, and by managing your risk effectively, you'll be better positioned to weather the inevitable storms and come out ahead in the long run. Patience is a virtue in the world of investing, and those who can maintain a long-term perspective are often the ones who succeed. Now let's talk about diversification. Just like you wouldn't put all your eggs in one basket, you shouldn't put all your crypto into a single asset. Diversification helps spread risk and can provide more stable returns over time. Diversification is key to mitigating risk. By spreading your investments across different cryptocurrencies, you're less exposed to the volatility of any single asset. This means that if one investment performs poorly, others may perform well, balancing out your overall portfolio. If one coin takes a hit, the others can potentially cushion the blow. This strategy can help you maintain a more stable investment journey, even in the face of market fluctuations. But diversification isn't just about holding a bunch of different coins, it's also about choosing assets that have different use cases, technologies, and risk profiles. This way, you're not just spreading your risk, but also tapping into various growth opportunities within the crypto space. Consider investing in a mix of established coins like Bitcoin and Ethereum, as well as some promising altcoins that align with your investment thesis. Established coins often provide more stability, while altcoins can offer higher growth potential. Remember, building a successful crypto portfolio takes time, research, and a solid understanding of your own risk tolerance. It's important to stay informed and continuously educate yourself about the market trends and new developments. Don't be afraid to start small, learn as you go, and gradually build a diversified portfolio that aligns with your long-term financial goals. The journey of investing is a continuous learning process, and with patience and diligence, you can navigate the crypto market successfully. So, there you have it, a deep dive into the world of crypto investing. We've explored different strategies, discussed the risks and rewards, and emphasized the importance of risk management and diversification. The crypto market is constantly evolving, and what worked yesterday might not work tomorrow. That's why it's crucial to stay informed, continue learning, and adapt your strategies as needed. The potential of blockchain technology is immense, and while the journey may be volatile, the future of crypto investing remains incredibly exciting. Always remember to do your own research, invest responsibly, and never stop exploring the possibilities within this dynamic and ever-changing landscape.